This first webinar is on preset portfolios. This is a new initiative that we launched that will hopefully provide our donors the opportunity to think about their asset allocation in a sort of easier way through this construct. So Michael Miller is our investment consultant. He's been with JCF for, I would say, close to 4 years, Michael. Is that correct?
I think that's right.
And Michael joined Colonial Consulting in 1986, and he's currently the firm's Chief Investment Officer. He provides advice on asset allocation, manager selection, performance evaluation, and he has 29 years of experience. He has been advising JCF on the investments that we add to our platform, as well as working with individual donors on their asset allocation. So without further ado, I'll introduce Michael, who will go over these preset portfolios with you.
Great. Thank you, Sue, and good morning, everybody. Or actually afternoon. Sorry, it depends on if you're in the East Coast afternoon. Again, thank you again, Sue. And I think everybody should have access to the slides, and I'm going to just use those as a guide to talk through some of the items and the thought process behind the preset portfolios and the outcome of those decisions as well. And I'd be happy at the end of my not too long formal remarks to take any questions that you might have. And I assume, I'm sure everyone's muted, but anyone who can speak, I'm assuming I can be heard fairly well, just to confirm that.
Yeah, we hear you. Thank you.
Oh, good. Thanks, Tamar. So flipping to the first slide, let's just start with a really a philosophical point of view, which is how we approach investing. And it's not the only way to do this, but it's the way we think is one of the better ways to do it. And we believe that because it's one of the easier ways to do it. I think investing is a very complicated subject in many ways, and what happens in a lot of cases is people try to do things that are very difficult to do. And when you do something difficult or attempt to do something difficult, your probability of success is not that high. And when you try to do something a little bit easier, your probability of success is higher. And for most of us, either whether it be for our fund at the Jewish Communal Fund or whether it be our personal assets, having a really bad outcome because we tried something that had low probability of success is really not it's not only undesirable, it can be disastrous for us. And so from that perspective, we tend to think that it's wise to focus on the one chance you get to do this right, to do it with an approach that has the highest probability of success. And so there's a lot of compromises around that, but let me walk you through that. So there's these 3 bullet points that we have here on this slide too. Point 1, you should think about establishing a mix of assets that is consistent with your return objectives and your tolerance for risk. And I'll come back to that a little bit later in terms of how you might define tolerance for risk. But the key thing is return and risk, which are the 2 metrics that investors tend to think about. And the bad news, of course, is that if you want higher returns, you tend to need to take on more risk, and vice versa. So if you're not interested in taking on risk, your returns will probably be pretty low, and that's particularly true today, of course. Second point, this is where people can get themselves into a little bit of trouble. There are a lot of people out there who claim to know or think they know where markets are going to go in the near term. And I think that's a really dangerous thing to do. At the end of the day, the returns of markets and the direction of markets are built on a very simple force, which is supply and demand for specific securities or markets as a whole. And I guess our concern when you try to predict those things is I'm not exactly sure how you predict supply and demand. You can see some of the factors that might lead to more supply or more demand, but you never see the whole equation. And that's why when you're surprised, if you are as much as I am, by the way markets behave, you probably shouldn't be, because again, we never get to see the whole picture. And I will also tell you that a lot of times you'll read or hear explanations for why markets did X or did Y, and even those are really not factual statements. Those are suppositions, and those are people, again, only seeing part of the equation but claiming it explains everything. And so that's a really dangerous thing. And that's why predicting market direction is very much in our mind clearly in the category of low probability of success. And then last but not least, though, there is one thing which has a high probability of success and allows you to get a little bit of a free lunch, which is to diversify your portfolio. And as you see these preset options in a moment, you'll see that's one of the big fundamental characteristics we applied, which is asset class and meaningful diversification is a really important thing, particularly when you are thinking of the world the way we are, which is we have a particular tolerance for risk, We'll try to get as much return as we can get for that level of risk. And we know there's a lot of things we don't know. And so as I'll speak just for myself, not for any of you or anyone on the investment committee or for anyone at JCF management or staff, but the ignorant man, and that would be me, diversifies. The knowledgeable man or knowledgeable person can concentrate, but you better not be wrong. And so that's a big part of the equation for us as well. So this is a simple philosophy, just to remind you what I said. Very long-term oriented around what you're trying to achieve with your returns and your ability to withstand risk. Avoid low probability decisions such as shifting the portfolio around because you think the market's going to go up or down. And 3, take advantage of the free lunch that does exist out there, which is diversification. I'm not going to run through the next couple slides. I'm going to flip these on the screen really quickly for you. Forgive me if it's faster than you'd like, but these are the options that I'm sure you've all seen many times over the years. This first page are the various bond options. The next page are the equity options that exist in the portfolio, as the choices on the public platform. And then there's another page of equity options because there's quite a few of them. And if you look through this list, and if you haven't looked at it before, you'll see there's a wide variety of managers, there's a wide variety of strategies, there's a wide variety of asset classes. So we have a pretty big menu to pick from. And what we did in this whole process is we were able to take this menu and then we applied some ideas of our own, and the committee's ideas of course, to decide on what the preset portfolio should look like. So this was our playing field for the preset portfolio, so to speak. So let me just, before we get to the preset options, let me just take one more second on risk tolerance. So there really are 3 things that should drive your risk tolerance. Two of them are fact-based, and one of them is very much the nature of each of us as individuals. So the fact-based ones are, number 1, plans for annual giving. So if you had a fund, the Jewish Communal Fund, and you had very little intention to distribute more than a few percentage points of it per year for as far as the eye could see, you probably could be argued of a very high risk tolerance. And the reason you do is because you're not spending down the fund very quickly. And therefore what happens is you can essentially ride out difficult market conditions and take advantage of the fact that over the long term, and long term is very long by the way, you will get paid in capital markets to take on risk, especially the way that we structure these pools. And so your plans for annual giving are a really big deal. Again, small percentage allocations or distributions each year imply that you probably have a long time horizon. Large distributions each year. So let's say you say, well, I've got my fund and I may or may not replenish it, but I know I'm going to take out a quarter of it per year for the next 4 years, or I think I'm going to. You by definition then have a very short time horizon because what happens is if you put that fund into a very aggressive strategy and we happen to hit a rough patch in the markets, it doesn't have to be a 2008 style rough patch, but any kind of meaningful rough patch, what will happen is we'll be losing, or the fund will be losing capital on a mark-to-market basis, and at the same time you'll be selling assets to pay for grants and other needs that you have for the fund. And so that's a dangerous combination. So you don't have the advantage of time, in which case I would argue to you that if you take short-term money and put it in long-term investments, you're basically gambling, unless you believe that you know something about market direction, which as I said earlier, good luck with that. So plans for annual giving tie directly into time horizon of your investments and your portfolio. And again, you might have, by the way, there'll be all kinds of different rules here in terms of how you're going to do this, but the bottom line is to think about what your plans are, how much you plan to distribute over the next year, 3 years, 5 years, and that really helps you think about time horizon. And then we've got this other little bullet point out here, psychology. Psychology is a really big deal. Now we're out of the world of fact-based and we're into the world of individuals and how you react to your portfolio, to seeing your statement value, et cetera, and how you think about your charitable goals in light of the changing value of your portfolio. Some people really have a very easy time with this. They don't get upset when their returns are negative. They don't get upset when things drop. I could probably, if we had time and if I ever get a chance to do this, I could make a very passionate case for why markets dropping are very good for long-term investors. I'll come back to that later. But the reality is nobody feels good when this is occurring. So psychology is a big deal. Now, if you're on the other end of the spectrum, some people get very upset when they see their account balance dropping, their fund balance dropping. And that doesn't make any good or bad person, of course, but if you get really upset with these things, then it's really important not to put yourself in a position where you're going to feel that way. And the reason it really does matter is because what will happen is the market will go down a lot at some point. It always does it. Bad things will be happening in the world when that happens. That's the way it always goes down. And the reality is that you will probably want to sell, and it might be the worst possible time. Then you will have done permanent damage to yourself. So it can be argued that if I'm a long-term investor and I really don't like losing money in any short-term period, there's a mismatch there and an inconsistency, and that's probably true. Except if I have to pick the quote-unquote lesser of evils, the lesser of evils would be just to put it in a low-risk portfolio that does not create any anxiety for you. It won't generate much return, but it's going to be a better outcome, most likely, than reaching for risk and return and then basically making what will probably be proved to later be bad decisions around when you take that risk out of your portfolio. So we worry about the fluidity of portfolios when people are getting upset about something. And so that's why psychology is such a big deal. And when I had the opportunity to talk to a lot of you on the phone, I'm not sure you realize what I'm doing, but I'm asking you all questions to try to figure out if I can get a quick sense of your psychology, even though I don't know you all very well, so it's probably a little bit too amateurish. But the bottom line is it's a really important part of the equation. So I will move on. I assume the slides are moving forward. I hope they are. So this is slide 7. So here are the rules we applied, or things you should think about in terms of how we put together the preset options. So number 1 is we wanted to offer options that cover the spectrum of returns and risk. So if you said to me, well, I heard all your stuff about my charitable goals and my psychology, and I'm a long-term investor, then we have a choice for you. On the other hand, you say, well, I heard all your stuff and I'm not a long-term investor, then we have a choice for you too. And we try to give you a few in the middle too, so because it is a continuum, it's not a binary situation. So cover the spectrum of risk and return. 2, what you're getting here is our recommendation. So when someone said to the investment committee and to Colonial, okay, if you had long-term assets and you had this public platform, exactly what would you do? And that's what you're getting. So we think, we're hoping over time it'll be evident that we're pretty good at this, and therefore you will get very good investment options as a result of that. So that's to be determined, of course, but nevertheless, that's what we did. And last but not least, this is not on autopilot. What we're doing here is we are going to be regularly reviewing the preset options in terms of their performance, in terms of the composition of those options, and asset mix, the managers we picked, everything. And so the committee meets at least 3 times a year, and they get on the phone more than that. And so there's going to be regular reviews. Now, I would be caution you that if you go back to the beginning of this presentation, so I will promise you 2 things that one will not happen, which is that we will not decide that we think the markets are going to drop suddenly and change the strategy. That will not happen because, again, we don't believe in that. And the other thing that won't happen is as a result of that, you won't see us radically shifting these options around over time. There will be periodic reviews. A lot of those reviews will result in no changes at all. Sometimes we'll make changes, and those changes will be based on our forward-looking estimates for what we think will happen on a long-term basis, never a short-term basis. So I'm going to dive into the options themselves. So here's the first one, lowest risk option, which is a money market portfolio. So I don't think I need to tell anyone on this phone call, on this webinar, that this is essentially the safe option, and it's, I guess we live in a perfect world in the sense that there literally is no return from this portfolio. And so therefore, that's the times we live in. And so this is for those of you, this is really if you have a very short horizon and you're probably going to grant out or distribute the money really quickly because you're going to earn nothing on it, but it will be safe. And so that's the first option. The next option, which we call the conservative portfolio, and you can see in the title we've defined it as having a 1 to 3 year horizon. And that's what we think of as the grant-making horizon, the distribution horizon. And so, again, as I said earlier, if you thought about distributing half of the fund in each of the next 2 years or a third in the next 3 years, this is probably the right option for you. By the way, if you thought about distributing it all in 6 months, then this is probably not the right option for you because there is risk in this portfolio. And you can see it's really a 90% fixed income, 10% money market fund, and you can see the contributions or the allocations, within that to some of the managers on the platform. And it's a relatively low-risk portfolio. I will tell you, it is not a zero-risk portfolio. It can lose money, and it will lose money when interest rates are rising, frankly. It will not lose huge amounts of money, but it will lose. You will see negative returns from month to month or quarter to quarter. But over time, we think it will earn a couple percentage points a year, which is better than cash, especially if you have a multi-year time horizon. So we'll keep going. Just a couple more. This is the moderate portfolio, sometimes referred to as a balanced portfolio. And you can see we've actually balanced it just perfectly. It's 50% stocks, 50% bonds. You can also see that on the stock side of the portfolio, which is the far right-hand side, you can see that we have a lot of Vanguard names there, and those are basically index funds. And so we've made the choice that the index fund option is a great way to keep costs down and a great way to have very strong returns. And so you'll see that we essentially have, if you take the first two lines, that's 22.5 and 5, that's 27.5 total. That's the U.S. stock portion of the portfolio, and then 22.5% is outside the U.S. When I talk to a lot of you individually, I hear a lot of bias towards U.S. stocks. As you can see in this slide, we're arguing that you probably should not have such a huge bias to U.S. stocks, and that's why you see this balance the way it's structured. So I will move on to one more. So this is the longest term. So for those of you who are both have very modest annual grant or charitable intent in mind at the moment, and who also know that you can and believe in, and I'm sure you're good at judging yourselves, believe that you can ride out the storms that will come along. Here again, you see now we have a 65% stock, 35% bond portfolio, and you can see as we've done before. The 65% in stocks is distributed around index funds with a bias towards the U.S., but not a large one. And the bond piece, as was the case before, owns some non-investment grade bonds. That's the PIMCO and the T. Rowe Price. It owns some international bonds, which is the Vanguard again, and then it owns some short-term bonds, which is the BlackRock JCF option at the bottom. So these are the four choices that we have at the moment. And then I'm going to have one more quick slide, and then I'm going to open it up to any questions you have, of course. And this is slide 12. I can't seem to make it go over there for some reason. Let me try to get this. There it goes. So again, just a few quick thoughts on the markets, which a lot of this informed us, the decisions you saw before and everything I've said before. So one, if you think this is a complicated time to be an investor, I agree. With negative interest rates in parts of the world and the bond market and yields being as low as they are, it's a really messy time. And markets have become more volatile in the last 6 to 9 months after a very nice placid period that we all knew would end, but just didn't know when it would end. And the complexity and the volatility, does make it very difficult. And there really are two ways you can think about this. One is to say, gosh, I don't want to take any risk in a complex time, and if that's your conclusion, we have a low risk option. We actually have two of them in this set of choices here, so that's good news. On the other hand, I will tell you, just to be a contrarian for a second, when things are messy and complicated, and when everybody's aware of those things, and I don't know anybody who's not aware of how messy things are today, frequently it's a very good time to be an investor, especially if you have a long time horizon. And so that's a really important part of the equation. So it's not all bad news, even though the world has all kinds of problems, which I will not dive into now, of course, but the world always has lots of problems. And some of these will be fixed, and some of them won't, and there'll be new problems, and all kinds of things will happen in the future. And there is really, truly, you have to believe this, on a very long-term basis, there is a return to be earned on providing capital to equities and through equities and bonds. That's the way it works over very long periods of time. That's a big part of the equation. Second point, it's not hard to see why returns may not be as great as we would like them to be. When you have low interest rates, it's a mathematical certainty that we will not have high rates of return on bonds. U.S. stock valuations, which is a more complicated topic, are not great today. So we can't say, wow, it's really a fantastic time long-term to own U.S. stocks and tons of them, which is why you'll see we had a lot of non-U.S. in the equation. But nevertheless, those things are the negative factors, but the complexity, I think, is the overriding factor that should be useful. A lot of times people will say to me, well, you have to have a short-term view because things are so difficult today and challenging and complicated. And again, in the world of the imperfections of what I'm suggesting, it would be wonderful to have some sense of what would happen in the short term. Because we don't, though, my argument would be just the opposite, which is, yes, it is more complicated today, and yes, it is more difficult to know, and that's why it's actually not a good idea to try to make a prediction, because it's so difficult to know what will happen, and that can be more damaging than in other time periods. And last but not least, as I said earlier today, early in this call, pessimism. The more you see pessimism out there, if you're in this for the long term, the better you should feel. The more you see people getting comfortable and feeling optimistic about the future, the more nervous you should get. That's frankly investment psychology 101. It works because most people don't react that way to these things. And when the day comes that people all see pessimism as a good thing, well, I guess we wouldn't have that much pessimism, I suppose, if you played out the logical argument here. But the reality is that when we have a lot of pessimism and a lot of things are happening in the world that are not so good, you actually do have relatively cheap prices in markets, and that gives you opportunities. Again, assuming that you can ride out the storms that will come, and that you will really essentially, I wouldn't argue you should ever close your eyes, but you close your eyes a little and not look quarter to quarter at how the portfolios are doing, your funds are doing. So I'm going to stop there and see if there are any questions that I might be able to answer or anything that you'd like me to expand on a little bit more.
Thank you so much, Michael. Before we open up, before I unmute all the lines, I just wanted to address a few questions that came up. You could view all of these preset portfolios on our website, which is jcfny.org/investments. That's the direct link, jcfny.org/investments. And if you'd like to change your investment allocation, we now have an online form where you could log in to your online donor portal and then just use that online form to change your investment allocation.
I want to thank you all again for being on the call. And as you sort of look at these portfolios and think about your own time horizons and asset allocation, if you have additional questions, feel free to email Igor. It's igor@jcfny.org, and he will get you the answers to your questions. And I want to thank Michael for joining us and for being such a partner to us and the investment committee in making these thoughtful decisions for our donors.